As retailers entered the lockdown in March 2020, a small, diverse group of Canadian thought leaders gathered to virtually speculate, collaborate, and share their insights on the waves of disruption facing retailers. The Business of Retail podcast emerged as an unflinching strategic alternative to the conventional discourse, revealing challenges in the headlines and exploring new, unconventional paths for all facets of the retail industry. Now, here's the panel.
Welcome to today's podcast on the business of retail. I'm David Gray. As per usual, I'm joined by Gary Newbury. Give us a wave, Gary. George Minikakis, Christine Cowan from Portland, expat Canadian, and Craig Patterson, Mr. Retail Insider. Today, we're going to be talking about something that isn't sort of front of house and the customer-centric theme that we've been hitting up lately. It's the notion that the pandemic is highlighting the importance of capitalization in the retail sector. So we want to talk today a little bit about capital structures and the importance of the funding needed not only to get through the retail transformation that's been occurring over an arc of time, but particularly to emerge through the pandemic.
So here we are, 7 months in. A lot of businesses are struggling. We know that. We've seen some restructuring happen. We've seen some bankruptcies happen. And, I think we all agree that it's not over by any stretch of the imagination yet. We're still waiting for that next shoe to drop. So the real question that I have in my mind about all of this is, just how much more will happen and what do companies need to do to get out of it and to get to the other side of it. So one thing that's the low-hanging fruit here for me is that, absolutely retailers are going to have to exit out of a lot of properties that are underperforming. That's the given. The next part is going to be, once you've done that, how do you retain those customers who you've lost from those stores? How do you get that revenue back into the stream, and how fast can you do it? Can you transfer it to other stores? There's the level of cannibalization that doesn't always transfer that easy. And at the same time, it's the level of competition that the landscape is changing on that, and can you keep that revenue moving? And if you haven't invested enough capital into those digital assets in the last 7 months, which I hope most retailers have, if they were lagging, then what's the solutions? The customers, we don't know how many of them are coming back, when they're coming back, and what that revenue stream is going to look like. But if a retailer is going to try and survive with 10, maybe 20% less in revenue, what needs to change? And those are kind of the things that are in the back of my mind. I think I'm pretty on the mark about less stores. Your inventory is going to change. Your pricing strategies might change. How you merchandise, how you sell online, and how you actually interact with customers online. I think that just having that chatbot is not enough.
It's interesting that if we go back quite a few years before COVID, the trend to smaller footprint stores, when you would go to conferences and a leader would be on stage talking about it, they'd say, this is customer driven and we're all about the customer. But my feeling was really that was accountant driven, and it was born out of necessity in a low growth environment, highly competitive, even more competitive environment every year, with no real natural increase in demand in Western economies, Canada in particular. So how do we grow our business? It tended to be expense driven, and how do we save money to grow the bottom line? I don't think customers were coming up with the idea that we need to do all these different things, but we're fast learners. I think the risk that I don't know where the line is in this, but the risk is if things are driven too much from a financial lens and not a brand lens or a customer lens, at some point do you pay a price down the road where you've cut, hoping that the internet's going to save you because of its margins? And I guess that I don't have an answer for that, but I'd be curious what you guys think.
The internet's not going to save many retailers per se, and I think I've made this point previously. The kind of issue I have is we can see all these incremental changes that may have been made over the last 10, 15 years. Chop this, chop that, move the supply chain source to China because it's cheaper than local, and all those kind of tactical things, relatively tactical things. But the big kind of elephant in the room for me, and to some of the points that George made about, have they made investments in digital assets or whatever, is the thing that's not changing, as I reflected on it with some conversation I had earlier today, is let's imagine, a realistic view of life may be that nothing's going to change because the culture isn't changing within the actual business. And then I sort of ask the question, why isn't the culture changing? The thing that really needs to change fast is the culture, how we do things around here, what we're open to, how we innovate, and big, large-scale strategic questions around our survival. And they're all driven by culture, how we think about the world as a collective. So if the culture doesn't change, none of this happen. We may make small investments here, we may chop back here, we may continue down that path. But what would make culture change? Because I think this is the essence of a fundamental transformational change, as opposed to the one that many people talk about when we're doing a digital transformation or a transformation of some description. But fundamentally, I don't think many companies actually tackle culture because they can't actually necessarily describe it. You've got the plaque on a wall with the 5 or 6, this is what we're all about, but they don't actually execute that in reality. But how do we describe culture, and how do we then tackle it?
I agree with you on the culture imperative, but we a lot of our work is touching on that from a customer strategy point of view, making that shift happen. What we've seen is you need to have a little breathing space financially in that business in order to allow for the missteps and the arc of time to shift that. And whenever we've seen a client either start with or eventually end up in a place where they're really financially stressed, although you'd think that would be the imperative needed to create a culture change, what happens is it's all hands on deck just to keep survival mode going. So I think the irony of the COVID situation is it could be that catalyst for change for some, and for others it might just mean whatever change they were hoping to do may get temporarily or permanently blocked. And I think that comes back to our capital structure question. How do we finance our way through disruption of retail, but also through the pandemic? And I wonder from Craig's point of view, because with Craig we were talking earlier about, he has a bird's eye view on who is filing for insolvency. And a number of those are doing it because there's an opportunistic moment right now during COVID. There's no dark cloud over you if you do such a thing right now. But there are penalties to be paid for that. But Craig, what are you seeing out there, and how many of the filings do you feel are, opportunistic versus dire?
That's a good question, because some of the ones that I thought were opportunistic were actually needed, like Aldo shoes. The moment I heard about that one, I thought, oh, okay, yeah, well, maybe you want to get out of some leases and this is a great opportunity. But then you look at their financials that were released and I thought, wow, yeah, no, they were actually in trouble before all of this. And we didn't know because it's a private company. And sometimes, we don't have access to financials. And, I think it's a little bit of both, but it does look like some retailers were actually really struggling and we didn't realize it. And I think that's really quite shocking. And what that means is that we were already in a dire situation before COVID-19. And now this is just exacerbated, existing problems that were already there. But at the same time, I know that some companies are certainly looking, at a general restructuring, examining their operations, Whether or not they'd file, though, I think is another thing. I guess the question becomes, what are the benefits of filing? Probably getting out of some store leases would be a good one. And some may do that voluntarily. I sometimes wonder, too, the perception that the consumer has when a retailer files. Does that scare the consumer off? Because ultimately, if a Lululemon were to file for bankruptcy protection, which it's not, but as an example, would those loyal brand fans look at that and say, "Oh, what's wrong with them? Oh, this is a little bit." But since everyone else is doing it, it's becoming the cool thing. Maybe that's not the best way to put it, but
yeah. But I think the banks, though, I was on an M&A call today, and I listened to a bank dance around about how they would lend money to other businesses that are not publicly traded, or they're not secured with capital. Wasn't a lot of excitement lending money out, right? And if you look at Group Dynamite, I think, Craig, they bailed themselves out, right? They put up their own cash.
They got a very rich owner.
Yes, but that's what I'm saying. They put up their own cash. Would the bank have come to that rescue if it was anybody else? That's the question I have. So, it may be a fad, and it's acceptable, because in the past, I agree, in the past, going bankrupt or going through credit protection, that was almost a nail in the coffin, right? And today, maybe it's acceptable because everybody's going to do it, and because we need to get through this. That may be the case, but that doesn't mean you're going to get to the other side if you don't have the financial wherewithal to do it, right? So
yeah, like Swimco, right?
Yep.
Yeah, Swimco thought they're going to be able to turn everything around, shut maybe 5 of their 25 stores, and then bam, they couldn't make it. And it's really sad. 45-year-old family-owned business, really nice people, that owned it and ran it. And
yeah, so that's what I'm thinking, that it's not quite cut and dry.
So George, let's take out of the equation, if you're a retailer and you're in dire financial straits prior to COVID, and now you're just sinking, and I'm not going to name any names. So let's take those out of the equation and look at those who could be viable the other side of this, but need to really withstand two things. One is to get through the losses. And Aritzia is a great retailer. Their share price is going up. Everyone's talking about how well they're doing. They're operating at a loss. Like we get lost with that. So to fund those losses until the pandemic lifts is step one. Step two is investment in culture change, to Gary's point. And with that, there's a lot of systematic change that has to happen. That takes lifting as well. From a financial point of view, the money over and above day-to-day operations, where does that come from, and what are the options? And how are they changing, I guess, is really the question. Like, are there different imperatives now than there were before?
So the money, once you've restructured, right, the ability to raise capital, there are other areas, right? But you're also going to take out insurance, right? So that in case of defaults. So there's that, right? And how much equity there's left in the business. So some businesses, it depends on how much debt there was. So you've restructured it, and now you've got debt on inventory, and the inventory that at purchase price, the inventory is still saleable. The bank's fairly secure, right? The people that are on the hook, right, are the employees. Maybe have not been paid, although they should be getting paid first, right? The landlords are there too, right? There's a lot that you have to carry, and so at any given time, you better have at least 6 months of cash reserves on hand to be able to make it through, right? And I don't see how else. If you go month to month, in the good days, you could have gone month to month, right? And I know there were businesses that did that, but right now, I don't know how you can do that today when your revenue is down, and it's down. And like you said, Tricia is down. They're losing money, but there are others doing far worse. So how do you get there without having that reserve? And I don't know how banks. And back to the point about Gary's about culture. Culture doesn't change unless there's one thing that happens. It's fear. The fear of failure will change everything. It doesn't mean it's going to go for the better. It just changes things. And without that, I don't see culture changing. But the things that do have to change, if culture is one of them, the other thing that has to change in an organization is talent. Because what got you to your success initially is not, and it's unfortunate for the people that are working there, but it's not going to get you to the next place. But I have to say that if I was an employee in some of these privately held businesses, right? I would say, I think the founder has to leave first
Yeah.
and step aside and let a new leader come in and make those changes, because there is no way the founder will let go of the old culture and what they believed in. It will never change. And that's what I kind of look when I hear about companies restructuring, I look at who's still running it, and if they haven't brought in new blood to run it from the top and freely, and I mean freely, right, there is no way in the world that brand's going to succeed.
I concur with that. A lot of our work has dealt in that aspect of retail versus pubcos. However, I would wonder if it's the privately held businesses where there is an emotional investment from someone to carry through versus sort of the cold market lens of banks or from debt or public equity. It might be harder. Maybe if we looked crystal ball, who's going to come out of this? Maybe it is the companies like Dynamite where there's someone passionately getting behind it, and passion isn't always rational. The markets are rational.
Right. But not every, and as you know, and you know this as well, but not every privately held business has a successor, right? No. So they're the ones, for me, they're the ones that are on the edge, and you may have a passionate and financially well-off family that can, throw money in and keep the business going. But a lot of them don't, and they will restructure, but the leader, if they won't let go and bring somebody else in. Look, I know people who are CEOs and have worked for privately held businesses. They're not really a CEO, right? They're not performing as a CEO. I don't care anybody says to me, you can shoot me later for saying it, but they're not.
I know.
The founder's still there.
Yep. Or the main financier is still there.
Yeah.
We've got a good example of that perhaps in Canada. In every high street or main street or mall, where they dominate, almost physically dominate the apparel industry. You raised a point, George, about the fear of failure as being like a trigger to change. I actually think that actually may reinforce the current culture and make it even more stable, given all the change around it. The fear of, the assumption is, I guess, in there is that the guys who are in the decision-making capacity to actually say, okay, we're going to change this, and this is a strategy, we're going to raise this amount of money. I think there's an underlying assumption that they know the first step on this new path, much the same as they may have not known the first step on the digital transformation path. They probably got a glossy brochure from the system software provider and said, well, I think we might need to do this. And I just wonder if we're in a, for want of a better way of expressing it, some kind of capabilities gap here now. The COVID has actually said that this has been so disruptive that only those ones who have real capabilities and maybe a bit of cash in the bank to help them, but maybe they were the ones that were already performing well. If they already had the capability to get on the transformational journey, this would just not be a walk in the park, but it'd be, we can manage this, guys. We've got a growth mindset. We can learn through this. We can unlearn the old practices and make progress. But those people very much in a, let's call it a fixed mindset, I'm using that term in a psychological meaning, that they're rehearsing the same things. And they've been very successful rehearsing that in a very steady market. Now it's been disrupted, and it's like, how does this fit into this? I don't know how to, there's just, there's so much fear, there's so much resistance to trying to look at different ways of approaching this that
I'm going to say something to that, and I'm going to ask Christine to jump in, because I know she understands. I know David understands. We all understand branding, but I'm going to pick on Christine because she gets what I'm going to say. Everything starts with, in culture, everything starts with a purpose, and the purpose is the brand. That's where you begin. All right. And no one, and a lot of these other retailers out there, if you're, Gary, you touched on digital, you touched on everything else. Those things don't matter if you don't know what the brand stands for. Yeah.
I'm silently taking it all in over here. Yeah, I agree. I think I love the comments around founders. I feel like quite often a founder will lead a business to a level and the culture that goes with that. And then there's that defining moment, and whether it's COVID or what, who knows, whatever that defining moment is, then there's a need for transformation. And I think the challenge is the transformation of the leader often comes in, to your point, George, of let's bring someone in to help, but really they're still steering the ship. So there's a fear factor of letting go and saying it's time for someone new to come in to shepherd and lead the business to the next level. Again, the focus on the brand is the key, but it's also in times like this where I think it gives brands an opportunity to kind of redefine themselves and say, look, we've been entrenched in this culture. We've been doing the same thing. It's not working. How do we look at something else or another brand or another company that's successful in this space? And do we do things to shift and move our culture and our brand so that we are able to ride the storm and move through that? And again, I think the big key is around the consumer's perception of your brand. What do you stand for? How strongly are you defined by that? I think within large brands, you can shift and move, but there's got to be that North Star of what's the brand? What do we believe in? What's important to us? What are we going to do or not do around that? And then being really trustworthy and I think open to affecting change. And I think the best brands are open to change. They're constantly looking at how they can change, evolve, and move. And they're not afraid to sometimes step outside of their box and their comfort zone to push themselves to a new direction. Sadly enough, I think with COVID, there's probably a lot of entrenchment and fear factor of like, this is not the time to do that. I'm sure there are a lot of brands out there that are sort of hunkering down and saying, well, if we keep doing what we did before, like we can maybe eke it out. But I think if you look at the brands right now that were really strong and happening before COVID, they took a different perception. They were going direct to consumer. I mean, the fact that you could buy a bed direct to consumer, a mattress, is beyond me, or your luggage, or there's so many other brands out there that have taken the model that other brands have used and shifted and turned it and have become really successful in areas that we never would have thought of before. So I think the key is definitely the brand and staying true to your brand. And if your brand doesn't make sense, then you have to sit back and sort of say, wait, what do we have to shift and move here that's important to our consumer during this time that we can then assess and move forward with? But
can I plus on that though? Because you're talking about the consumer. I think even more important is what's in it for me as an employee. Like, because the consumers are going to shop and it matters to them, but maybe it's more of the values, like what is in this, what is this business about above and beyond me getting a paycheck and us selling more things?
Yeah.
And the one thing that's going on right now that might dampen that down is I think we're going to see a huge glut of incredibly talented people on the market. So maybe that era of I can pick and choose where I work and I'm going to work where I'm aligned on values, maybe that's going to give way for a little while to I just need a job.
Yeah.
But I think to George's point about change on the inside, I think that's where brand also matters a lot. It's why am I in this? Why am I going to go through a lot of disruption and discomfort?
Yeah.
Right. And if it's just to hold on to a job, I think people burn out from that. And going back to family business, the one thing I really like about family business, everything's got a pro and a con. The con is you can get entrenched in a baggage-laden legacy because of no change. But the upside is usually there is something that matters more than the buck. Like most brands that evolved out of something, the passion of those founders and usually it's first generation, but maybe subsequent, matters a lot. And you really can feel the difference compared to a business that was acquired, for example. So the brand can still look and feel all the same way, but it erodes.
Mm-hmm.
I can give, if you guys remember, for our listeners, they're probably way too young, but there was an amazing Western Canadian brand called Off the Wall Clothing back in the late 90s, early 2000s. And they were so smart. They sold at the peak and their guys retired. But it was a great clothing brand, jeans primary. And they sold to West 49, the people behind that. Within 2 years, the thing was blown up and gone because it's not just about all the parts and the and the external brand. It's like, there's got to be something more.
Mm-hmm.
That's the big challenge, is as those brands move and those founders, you know, the founder got the company to where it is, and there's the passion and the drive. And in many cases today, founders are really at the forefront. Like, you hear about founders more than you maybe would have in the past. And then it's that, I think, you know, the opportunity for them to carry the legacy and move it forward. And do they shift and move, or do they stagnate and, you know, fall by the wayside? And we've seen examples of many brands that have had those challenges. You know, I think now more than ever, there's this opportunity for that breakthrough. And I think you look at brands that are cause driven. I'd use Lulu as a great example. They really lead from the inside, and there's a causal aspect to a lot of what they do. And their culture is like that. The people that work there, you know, live and breathe that culture, whether it's the store staff or people internally in the company. And I think you'll start to, you know, maybe potentially see a bit more of that, where people, even though there's a challenge, to your point, David, of aligning with a culture that maybe isn't right, I do think that people are going to be more passionate about partnering with those brands that do bring that value, because they're looking for that, you know, piece of what can be really important to them beyond that 9-to-5 job. And, you know, I think we're all sitting in our work from home environments, and culture and community is a really big part of the success of, you know, some of these great brands. So, you know, that's an important aspect of it that I think, you know, can't be sort of discounted.
So let me throw something out there for you guys to bring it back to our topic this week, which is about capital structures. If there's a purpose-driven business and brand, and that inspires not only the founding family, but then subsequent leadership to come in and build off of that, and it inspires internally but externally as well. So, you know, talented vendors and partners want to work with this company, et cetera, et cetera. Where that breaks down in my mind right now, but maybe in an ideal world, there's a path through. How does capital find that business? In other words, is there a way that the financing of what needs to happen, which is not going to come out of earnings for a lot of these companies, can that be tapped strictly on the value of that brand purpose? Or is that decision making always going to be so cold and removed that there is no advantage being purpose driven in the eyes of a bank or a public market?
I would suggest that, you know, a bank or even a share issue, and it's all about an expected rate of return. So I'm going to put my money in as an investor, and if it pays me 2, 3, 4, 5, 10% per year for into the future, that's a more sensible investment for my money versus like put it in the savings account than necessarily put it in a purpose, unless I felt some huge affinity for it, and then I'd have to have a whole cohort of people, and it wouldn't probably be banks, that would be willing to see that investment going in with some very long-term view as to the overall good that it would produce as a result of that collective investment. So I've got a feeling that when you're talking about, you know, money, it's all about money. If you're talking about social purpose, you're talking about a business that's probably not likely to make a return for many years, if at all. And I'm not sure how many people would be really, when they get pushed, would actually put a substantial amount of their investment into a business that's not going to show them a return. It may feel good, but there are other alternatives where you can put your money in and maybe get, you know, a 10% return on capital over, you know, every year for, you know, for a measurable period of time.
That's at an extreme, you know, one end of the spectrum and the other end of the spectrum. But what about on the margin? Like, what about where it's taking on a little bit more risk, relatively speaking, but with a purpose-based business and maybe having to be a bit more patient on the return, marginally patient. And, you know, maybe we do know that there's been a growing movement towards social capital and social venture funds, like Renewal Partners out in BC is one of those, who were early on in Ben and Jerry's and supported Tom Zaki with TerraCycle and so on. So maybe there's that. And then ironically, we could talk a little bit later on this, but co-ops were in the news recently, one in particular. Like maybe it's going to take another structure. But the issue is those funding has to come from somewhere. So why would people care?
So I think what we need to, if we could just step back for 1 minute though, and let's pretend we're right back to the initial start of this conversation, right? If I'm a banker, I'm going to say, let's do the math here. I've got COVID-19 as an issue. I have malls that have been closed and have been eroding over time prior to COVID-19. Prior to COVID-19, and Craig probably has a number in his head somewhere or in a piece of paper that says how many retailers have closed or how many total stores have closed in Canada and maybe even globally. I'm sure you can find it. You may not have it right now. But if I'm a banker and I'm thinking of all this, I'm going to say, okay, if I were to put my money on a retailer today, they would have to be a retailer that's, that the consumer has a relationship with, that it's a continued relationship. And that relationship comes from branding. And it's that being a relevant brand, being consistent and being meaningful. And that you've just fallen on hard times. You were a really pretty good retailer before, right? You didn't have any issues with managing your store counts, your paying for your inventory. You had no issues. Suddenly you do, you're okay, right? But if you don't fall into that bucket, then you're not okay. And I think that's where all of this separates. But the retailer, to get that funding, is going to have shown that in the past they were a proven success, and that right now they just need to clean up their house to get back on track. That's it for me. That would be, if you asked me to put my money into someone, that would be how I would do it. I would not be throwing my money against anyone else because I just don't see it.
I don't know if the banks are the ones for that, but maybe there's private lenders, because I do think there's a patient capital aspect about this. And by that, I mean the ability to invest now and just wait a while before those returns hit and actually be able to stomach the fact that it's going to go down before it comes up.
I feel like Associated Brands Group, they acquired Barney's New York, for example. That was a sinking ship, but they had a vision to make it into something new, which was a partnership with Saks Fifth Avenue.
Here we go.
That's obviously not a bank, but it's a group that saw promise in a brand. I'm not sure if there's something behind this beyond what we're seeing at the front in terms of, maybe they want to milk these brands and then
Sure, but there are buyers of zombie brands right now, right? I mean, I can't remember their names, but there's a NASA engineer and I forget who the other partner is, and they're in the U.S. and they've acquired Pier 1 and some other retailer that they're putting together, and they're acquiring zombie brands, and that's something that's different. That is different because they're not taking it back to physical retail.
Would MEC be in that category then with Kingswood? They're saying they're going to keep stores open. What are your thoughts there, George?
You know what? I love retail, right? I'd love to see the world to be where it was before, where people shopping and having a purpose to shop and feeling good about it. I believe, look, we're social creatures. We need to see things, we need to be seen, and we want to be in a safe environment. I think the world has kind of moved, and I don't know how quickly it's going to regroup. It will again. It may be a generation before we see things the way they used to be, and that whole thing cleanses itself. But I think, store counts, I go back to department stores. Why do you need more than one in a major city, right? And then when it comes to major retailers, how many stores constitutes a chain going forward? If all I need to do is see your product, and if I want to pick it up, how many locations do you really need if I'm going to buy online? Because that's a pattern that we have right now. It's a behavioral change that we've seen. And the good thing about this podcast is you guys can disagree with me, but right now, I have shifted my mind about how things are playing out.
Well, should I just say you're full of crap then, George, just to spark,
Yeah. Okay.
you know,
We're going at it now.
just for its own sake. Well, imagine a world where there's no physical retail, right? Down the road.
Yep. No, it's not
I guarantee there's going to be some punk ass innovator who comes up with this notion of, hey, why don't we take the product that's online and we can kind of carry it with us to a spot, and we can actually kind of give it an exchange with people at that spot, maybe just temporarily, but
what a novel idea.
Because I think eventually, like the real answer is going to be a mix. I really do, but it ebbs and flows and everything else. But I think I can speak for myself, but a lot of other people I know, that they're not thrilled with all the experiences they're getting online right now.
No.
And where you can actually kind of get something online, but if it's wrong, you could then go over to the store and have them sort it out for you. As a customer, it's nice. We keep coming back to the cost of operating that. And I think the real challenge, though, is societally, we've been driving costs down, the price of what we want to pay for things. We didn't create that, but we've now adapted to that notion that every year it should be cheaper. And
if I'm full of crap, you're a romantic.
I know.
All right. Yeah, so here comes my side of the equation. The public, why do you shop in stores? Or why do you go to places like Loblaws, Canadian Tire, Target? Why do you go to because it's convenient. Because you know they have a product that you want, and you know you can get it there, and you're going to pick it up because you want instant gratification.
That's part of it, but also it depends. Maybe there's different shopper styles.
It's true.
To be able to see what's there, like oh yeah, I need that. I'm looking, because I find right now that if you think of Amazon on the web, it's such a uninteresting, flat. It's like this sea of just product. There's nothing that's convincing me that.
Yeah, but at the end of the day, if I'm going to go to a store today, which store am I going to go to for an experience today? Which one? Unless I go to luxury.
Yeah.
Tell me one store that because my idea of an experience.
Golf Town.
Right? No, sorry.
Well, my local golf town was.
Okay, maybe they know you by. But my point is,
I don't do golf.
Well, why do you go there?
No, I just popped in there because I was going to have a chat with them.
But
now you're talking about solutions, and that's really interesting. I'm actually going to go to the Apple store today because I got to do something with my MacBook. I want someone to sit down with me and actually work it through. And maybe down the road, there'll be rich interfaces online that can enable it virtually. But right now it's... But
I'm going to come back to banking. Why should I lend you money if the consumer is buying, more of them are buying online right now, and put all my money, I'm going to lend all this money to keep all these stores open. Believe me, I'd rather see that stays the way it is. I just don't know, as somebody lending money out, that is the future, and how long is sustainable.
Yeah.
Well, I agree with you on banks. I don't think banks are that kind of.
But they're tied.
Answer. But I think there are others who might. And if you think about some of the crazy crap I've seen invested in by investors in the tech space, like ridiculous.
But
you can see it a mile away, you're throwing your money away, but someone wants to be part of that story.
David, they're kind of thinking this might be the next best new thing. Whereas when we've had stores for almost millennial, but centuries. So why would a PE, a bank, a set of rational investors actually say, oh, this store is going to, it might be a slightly new concept, but this is going to be the future of retail. Well, no, it's not. A store is not going to be the future of retail. It may be the future of a slice of a category within retail, but not retail. Whereas Amazon, when, he's had, to the point you made earlier about patient investors, retailing appears not to make money, or if it does, it makes marginal money. It makes some money on the subs. Its major money is made on AWS, but somewhere in how he's constructed that concept, he said, my social purpose is to be the most customer-centric organization in the world, and I'm going to operate globally. And investors have said, that's the way it's going to go. And you're on the internet. No retailers at the time, or not many of them, were on the internet.
If I were to buy a retail brand today that's going under, if I could pick one up, I won't say which one, I don't believe that I would have more than a dozen stores in Canada. That would be it. And I would be pushing my e-commerce platform. I would be investing in technology heavily to connect the stores and the experience to be the same in store as it is online.
By the way, I'm conceding my point here to you guys. If it's trying to preserve a museum piece,
right?
Then you're, yeah. I mean, that's a whole different thing. And definitely there has to be this moment of truth that you kind of look at this and say, hey, are these operators becoming systems thinkers, or are they still in channel mode? Like, hey, we just got to open more stores and we're saved. If it's that kind of thinking, that's old thinking, and I wouldn't invest in it. But I do think the future still is a mix of bricks and clicks for sure. But how that forms is going to take a lot of creativity and trial and error. I'm just curious if there's going to be creativity and trial and error on the financing side. Like, if everything else is getting disrupted, are we going to see more Kickstarter? I've seen a few brands out here in BC that have actually got their launch literally via Kickstarter and actually getting some decent funding. I was surprised.
So on that note, though, okay, so I want to make sure I get the acronym right. So it's special purpose acquisition companies, right? So the way they're structured, they basically set up. Craig and I get into business together. We start a business. We go we hit the road. We try to raise. I think the minimum in the U.S. is 50 million. In Canada, it's 30 million. The intent is you raise this capital. You don't have to identify an industry or a company that you're targeting. Only that you're going to, Craig and I. He's a lawyer. I'm a CEO. We both understand retail. We're going to get out there. We're going to look for opportunities to invest in. We say we want to raise $50 million to do these acquisitions in retail. We just don't know what it is going to be yet. And apparently that's the way it's being done. So I know of one group in the US, they have no business. They have not identified an industry or a business. They've raised $250 million. Okay. So in terms of where is the other money, David, I agree. There is how there are other means to raise capital, but they want to own these things outright. They're not going to just invest in it, be a small time investor.
Craig, I didn't know about that. So that now you're going to get me off after we're off the phone, starting to research that model. I didn't know. The other one I'm looking for is examples of where maybe different parts of the ecosystem come together to support each other. So, for example, stories emerging where the landlords or the malls are starting to invest in concepts. And Craig, you probably have some examples of that, I think more stateside than Canada.
Where landlords have invested. Well, what's interesting is that was already happening. Cadillac Fairview spent a lot of money on Frank and Oak a while back, like way before COVID, and apparently lost a lot of that money. Frank and Oak still filed and only has, actually, I don't know how many stores they have. They're supposed to have 3, but I heard they still have 9 that are open right now. But the landlords right now, in a lot of cases, they weren't receiving rents. We just read about the Hudson Bay Company being, in arrears quite a bit. And I think there's many other examples as well. I think landlords are doing this very selectively. They're looking at, who's going to possibly be a star in the future and helping them. And I'm not sure what the extent of that investment would be. I mean, I think that would be dependent on, what they think the future of that retailer would be. Some other retailers, they won't even help them with lease negotiations. They're just saying basically you're on your own, and that's going to result in the shutdown of that retailer probably. So I think it depends. But yeah, we are seeing a little bit more in like Simon Property Group investing in the States. I think we're seeing a bit more down there right now, but who knows? This may come here very soon.
Christine, we've talked about this before on the podcast, but maybe there's other examples, but you've talked about Allbirds and Adidas, with Adidas funding some initiatives with Allbirds. Like, are you seeing more of that? kind of cross-pollination where someone has some cash on hand and they're going either to a competitor or a complementary business and injecting the capital.
Yeah, I mean, we've been seeing, collaborations have been going on for years. So, you definitely got the fashion brands collaborating with different companies, and, it's a one-hit wonder. But I think that example, I can't really think of another one off the top of my head, but I think they're a great example of two companies that you could argue are competitors. They both, now actually Allbirds has launched apparel. So they've quietly been doing socks and some underwear, and now they're launching product, wool garments, which will be interesting to see. You think about brands like, you typically wouldn't see that. So I think it's really refreshing to see brands partnering together. Their partnership is really based on coming up with, the most sustainable footwear in a closed cycle situation. So I think they're partnering together to get to that common good opportunity, and I think it'll help both brands. And I think there's something really great and unique about that, kind of going back to that social purpose. Like, how do you partner with another brand that maybe is in a similar space but wants to kind of get to the common good? And I think there's so much opportunity around that. But it takes a lot of trust and putting aside the ego to say, I'm this brand and I'm this brand, and we're both competitors in this space, but how do we work together for that, common good? And we saw it a lot at the beginning of COVID, where brands were partnering to do, PPE and things like that, and supply chains were partnering on different things. But, I do think there's more of an opportunity around that. And it'll be interesting to see how brands kind of move into the future around that. And what interesting collaborations will start to kind of pop up from this. But when you think about it, there's a lot of survivalist situations where, mid-tier brands could easily partner with each other on similar, goals and aspirations and come up with something really compelling. So I think it could be really, really interesting to see more of that. But I applaud them for, their work together, and we've yet to see what they come up with. But I think it's really exciting to kind of think about where that might lead us.
And David, earlier you talked about off the wall.
Yep.
And I do believe that there will be regional brands that will do very well. They may just be 2 or 3 stores today, and they can grow to maybe 10 or 15. But those regional brands may never cross the border somewhere anywhere else, because that expansion has killed so many of them in the past. So when we talk about financing and how do you manage all of that, you just avoid that. And I can see, the malls of the future having regionally being very merchandised very different by retailers than they are today. Where you've got a lot of national players. There probably will be few national players coming out of this.
Well, I also wonder, to that point, when you think about who has a vested interest in the survival of retail, it could be the manufacturers, and and it could be ones we don't even know, maybe offshore in Asia where they have cash, securing at least temporarily a pipeline out to the consumer. And it's interesting what happened with Amer Sports, which is Solomon and Arc'teryx and so on. Like they got acquired by their Chinese manufacturer. I wonder if we're going to see more of that as part of the shakeout.
Yeah.
If China potentially, and obviously I'm making a generalized comment here, but if you look at what's happening across the world in places like Africa, where they've got in first with their investments, they say, we come and give you some money, but you have to just do this small thing, which is actually quite a strategic infrastructural change to how they do things. This stage of our retail disruption may be the perfect setting for China or its financing from China to step in and absorb some of the retailing space to be able to be a very good conduit from China straight into retail stores and out to consumers. And there may be special, just small little things that you have to do, which become quite substantial as we roll forward the clock.
You know what could be a really interesting strategy as you think about, I'll use Canada as an example, the malls across Canada, and you have the same retailers they've got to have their brand store in every single mall across Canada, if not 3 or 4 malls. So George, I agree with your point around like the shrinking of retail and being specific within each of these areas. But you think about Etsy. Like, what if you took the Etsy concept and you take these malls across the country that are now vacated, and it becomes more of a maker space? So these smaller brands that are not able to have their own brick and mortar get into a shared space where makers can be, and they can churn in and out. Sure. You can do pop-ups, things like that. I mean, I think there's so much opportunity to think about it in a different way, and how do you take advantage of that for these smaller retailers to be more successful, because it's challenging for them out in this world to be in a place where people can be exposed to them. So it's just, I don't know, it's an interesting thought to think about how that might sort of help bring more excitement to retail as well. But I definitely think that land grab of we've got to have a 5 stores in every major market. Like, I think we need to be more selective with what's out there and what we're all exposed to. It might mean we have to drive a little further to get there, but at least we have a great brand experience when we're there.
Mm-hmm. Then they can afford to do it.
Yeah.
Right? Because when you're stretched on store counts, trying to meet costs for stores that aren't delivering. And I think that's, if I could start off by kind of closing this off, the secret for me is, that everything that we've done in the past was all about this absolute growth and expansion, and it was costly. So today, yes, the consumer, it's not the consumer only that has an alternate channel. Retailers have an alternate channel. Because if you're going to have a brand, that brand extension goes beyond the physical space. And because of that, you don't need to have as much cost structure underneath you that really erodes at your profitability and distracts you from building a brand. I think David started it off by saying, that, companies were, how distracted they could become just by trying to manage their accounting and their finances. But if you can just be focused on building a brand and not going crazy on growth, and so you make $1 billion a year, you're not making 1.2 billion a year, but you're more profitable, right? Then you're more attractive to everybody.
I heard through the grapevine that might be the play we were seeing with David's Tea. Like, I was so shocked at the scale back that they undertook that it suggested to me they're done. What I'm hearing is no, they're not done, but they had this realization that the path they were on, which is to keep opening stores and hope for an exit down the road, was absolutely the wrong way to go. And that, to your point, George, they don't need in a market or across a large geography that many stores. And I think, what is it, Craig? Are they at about 18 now or 13?
I have to check on that, actually.
They were in the 100 and way back, but apparently they feel that they're on incredibly solid footing. They're just not shooting for that growth that the old strategy was on, was keep opening and hope you can flip it.
Mm-hmm.
So yeah, it's a good point. I think we're coming to the end of our time here. If I had one last question, I guess, and maybe again, it's George is our CEO in residence, so to speak. If you are a CEO and you're dealing with a number of things through the pandemic, to what degree are you looking at alternative financial models, business models in terms of their funding for you, but also sources of capital, versus what tended to be the play, which was, hey, we just got to cut costs.
Abandon cutting costs, because I think you've already exhausted that venue, right? I think everyone has exhausted where else you can cut. It's about what else can we do? And that would be everyone's focus. So it's about growing your product lines, changing your product lines, adding the experience take in store and online. It's a lot of footwork that needs to be done between now and whenever that opening comes back again. But the one thing is that I believe retailers have time. The ones that survive and go through any transitions they have to go through, they have time to get it right. But if they stay the status quo, that they're going to find their way out of the marketplace. But that getting it right has to do with keep asking that one question: what else can we do? And each brand will be very, very different.
Yeah. Well, listen, folks, I think as always, we start one place and we cover a lot of ground. But my takeaway on this is that, as is our theme almost every time we do this, if you're a retailer wedded to your old retail concepts and channel philosophies and retail is what it was 10 years ago, like everywhere else from a consumer perspective, employee perspective, here a funding perspective, you're not going to get your funding. So it's got to be about the future, but it sounds like what we're also exploring is new disruptions in the levers of funding. We didn't even talk about subscription models and things like that today, but in terms of tapping capital and patient capital and people who are willing to invest in the sector, it sounds like there's some things changing there as well. So anyway, until next time, folks, David Gray, Gary Newbury, George Minikakis, Christine Cowan, and Craig Patterson signing off.
You have been listening to the Business of Retail podcast, an unflinching strategic alternative to the conventional industry discourse. Thank you for joining us. For more information, please go to www.thebusinessofretail.ca.